Well, the first thing you have to figure out is, are you really going to owe a bunch of taxes? You know, if there's not a big tax liability, it's probably, you might as well just take your money and then go buy something else. But if there is a significant tax liability, the next thing that we really have to look at is whether or not you have another piece of property, or we can find you something that would qualify, that would be suitable. And now you've got the basis for a 1031. You know, you're going to sell it, you've got tax liability, and you've got something else that you might want to put your money in. And so then there are very specific rules. For one thing, you have to have what's called a qualified intermediary. You can't take possession of that money or you owe taxes on it. And then you have to follow the rules specifically. You have to identify the property within 45 days, and you have to close the sale within 180 days of the purchase. And if you violate that by one day, you owe all the taxes. And that can be hundreds of thousands of dollars. You need to make sure you work with someone that understands the rules and will hold you accountable to them. Because I've been, in 30 years, I've ran across situations where people will go to a financial institution and they miss it by one day. There are qualified intermediaries, companies that do nothing but this. And so we typically will work between the client and the qualified intermediary to make sure that those things, so that whenever it's time to close the sale gets closed. Because the Internal Revenue Code has no flexibility. The clock starts running on the day of sale, and if you miss it by 1 minute, then you get to pay all those taxes.